Welcome to this explainer. If you're a college student staring down a massive corporate finance exam, or just a focused learner trying to figure out how Wall Street actually values companies, well, you're in the exact right place. Today, we're demystifying a huge one. We are talking about the dividend discount model, or DDM. It's one of the most fundamental and honestly often misunderstood valuation tools out there. We're going to strip away all that intimidating algebra and reveal a toolkit that's actually super intuitive. Let's get into it.
So here's our roadmap for today. We'll start with the heart of valuation, look at the core dividend model, adapt it for different company growth stages, tackle the mystery of zero dividend stocks, and finally, look at the data to see if this model actually beats the market.
All right, part one, the heart of valuation, uncovering intrinsic worth.
Now, before we even touch the math, we've got to get our philosophy straight. Valuation expert Aswath Damodaran loves to point to this Oscar Wilde quote, and it perfectly captures what we call the bigger fool theory of investing. You know the game, right? It's that dangerous, speculative trap where you buy an asset simply hoping that some bigger fool is going to pay a higher price for it later on. But listen, that's just relative pricing. That is not true valuation. So, how do we find true value? If we're refusing to just gamble on market vibes and perceptions, we have to anchor ourselves to reality. We need an asset's intrinsic value. And the fundamental postulate of sound finance is literally just this. An asset's price should solely reflect the present value of the expected cash flows it's going to generate. Think about it. You don't buy a financial asset because it looks pretty. You buy it for the cold, hard cash you expect it to put back in your pocket over time.
Moving on to part two, the core dividend model, your foundational equation.
Okay, let's look at the direct application. When you buy a publicly traded stock, the only actual cash flow the company hands you directly is the dividend. So when you look at this DDM formula, don't panic. Don't see it as intimidating algebra. It's really just a logical recipe. It's telling us a stock's intrinsic value is simply the present value of all its expected future dividends. And you see that t equals 1 to infinity part at the top? Well, because a corporation technically lives forever, we have to project out all the cash it will ever hand you, stretching out into infinity, and then discount all of that back to what it's worth at this exact second.
Really, the whole thing boils down to two vital inputs. The top half is your expected cash reward, the dividends per share. The bottom half, that's your penalty for risk, the cost of equity. If you're a finance student, you'll probably calculate this bottom half using CAPM, the capital asset pricing model, to figure out your required rate of return based on how volatile the stock is compared to the broader market. So you project the cash, evaluate the risk, discount it back. It's a pretty elegant balancing act, honestly.
All right, part three, modeling company growth stages, adapting to reality.
Now, as any finance student out there knows for sure, assuming a company is going to grow its dividends at a single static rate forever is a fantastic way to instantly fail a valuation exam. Real companies have life cycles, and we can map that journey through three distinct stages. First, you have an initial high-growth boom, right? The company is dominating a new market. Second is a transition period. Competition sneaks in, the market gets saturated, and growth gradually cools off. And third, they reach a mature, stable, forever state where this massive firm just kind of grows alongside the general economy.
So let's map out exactly how this impacts the actual numbers. Take a look at the top line there, representing earnings growth. It starts off super high, slopes downwards during that transition phase, and then totally flatlines in stable growth. Now check out the bottom line, representing the dividend payout ratio. Guys, this is the secret sauce of the whole model. As a company matures and its massive growth slows down, it doesn't need to aggressively pump cash back into new factories or R&D anymore. So naturally, the percentage of earnings it pays out to you as dividends goes up.
Okay, so you're building a DDM model, and it suddenly spits out totally crazy numbers. It happens. Use this practical troubleshooting cheat sheet right here. It's derived directly from valuation experts. If your calculated value is unbelievably low, check your stable payout ratio. If it's sitting under 40% for a mature firm, you're basically artificially starving the model of cash. Or check your beta. If it's too high, your discount rate is just crushing your present value. On the flip side, if your value is absurdly high, make sure your long-term growth rate isn't wildly beating the overall growth of the broader economy. Remember, no company outgrows the entire world forever.
Moving right along to part four, valuing zero dividend stocks, the anomaly.
Okay, this brings us to a massive misconception. So many students, and honestly, even a lot of professionals, believe the DDM is completely useless for valuing the next big tech startup. They assume it only works for boring, mature utility companies mailing out steady quarterly checks. But, as our source material explicitly details, that's a total myth. You absolutely can and absolutely should adapt the DDM for non-dividend paying stocks.
Here's the logic you really need to internalize. A high-growth startup is currently reinvesting 100% of its cash to capture market share, right? So, zero dividends today. But remember those growth stages we just talked about? Eventually, that explosive growth has to subside. And as the growth rate drops over time, the firm's capacity to pay out dividends will organically increase. By structuring our models to project the dividends a company will be capable of paying once it matures, the DDM still works flawlessly. We're valuing its future capacity, not just what it's paying out today.
Now, a classic college exam curveball is being asked to compare the DDM to free cash flow to equity, or FCFE models. The key difference here isn't the math, it's actually a behavioral assumption about management. See, the DDM assumes only scheduled dividends are paid out, and it essentially trusts management to safely invest the leftover cash pile. FCFE, on the other hand, assumes every single penny of available cash is paid out to shareholders immediately. So your choice of model depends entirely on your assumptions about how a company's management handles its cash.
And finally, part 5. Does the model work? Let's step out of the classroom for a second and look at some actual historical market data. Check out this fascinating 13-year study. They classified 250 stocks into quintiles, from most undervalued to most overvalued, relying strictly on the DDM, and the results are wild. Over the long term, the portfolio of undervalued stocks, the ones the model flagged as cheap, massively outperformed the overvalued ones, and even beat the broader S&P 500. Over the entire period, that undervalued group generated returns exceeding 1,200%. But here comes the academic reality check. Using the DDM requires immense psychological patience. It absolutely does not beat the market every single year. In fact, in that exact same study, it underperformed in 6 out of those 13 years, so year-to-year performance can be highly volatile. Plus, because the math naturally heavily weights near-term dividend payouts, the model strongly biases towards selecting low PE, high-yield stocks as its winners. It's effectively acting as a value investing screener.
And that leads to a genuinely fascinating critique of all this complex math. Some researchers argue the DDM might honestly just be an overly complicated way of finding basic value stocks. Studies actually show that simply screening the market for low price-to-earnings ratios adds 0.92% to your quarterly returns. Running all the complex algebra of the DDM on top of that, it only adds a tiny further edge of 0.06%. It really forces you to ask, is the sophisticated financial modeling generating the alpha, or are the basic underlying fundamentals doing all the heavy lifting?
So as you take these concepts back to your finance studies or your own personal portfolios, consider this final thought. The DDM is an incredibly adaptable tool that forces you to rigorously link a stock's price to its underlying cash fundamentals. But are you just going to plug numbers into a spreadsheet blindly to pass a test? Or will you use the model as a flexible, critical lens to navigate the chaotic realities of Wall Street? Thanks for joining me on this explainer, and keep questioning the true value of everything.